Did we just avoid a recession? GDP came in at 3% growth, which is significantly higher than last quarter, where it was negative 0.5%. It was also higher than the estimate of 2.3%. Had we have seen negative GDP in this quarter, that would have been a technical recession because 2 quarters in a row of negative GDP growth is considered a recession by a lot of metrics. However, we are seeing the unemployment rate significantly lower than what you would typically see in a recession. Right now, we're still at 4.1%, indicating the job market is pretty strong. But actually, one of the reasons we got negative GDP in Q1 of this year is primarily because so many companies front-ran the implementation of tariffs. They wanted to import as much as they could before tariffs increased the cost of their products. So where do we stand now? Well, GDP has grown a decent amount in Q2 of this year, and unemployment is still at 4.1%. So if we're just looking at the data, it doesn't really seem like the discussion of a recession is even on the table right now. Where does this leave mortgage rates and the housing market? Well, expect mortgage rates to remain elevated in the near future between 6.5% and 7%. Hopefully they don't go above 7%, but if the unemployment continues declining and inflation goes up, then who knows what's going to happen to mortgage rates. As of right now, we're still expecting between 1 and 2 rate cuts before the end of the year, but that won't necessarily have a direct impact on mortgage rates. What would is the unemployment rate increasing and inflation going down below 2%. That would actually get investor consensus to show that the Fed is likely going to have multiple rate cuts next year, and as a result, mortgage rates will decline because of that. And the housing market's probably just going to trend toward a neutral market, with pockets of the country being a buyer's market and other parts of the country being still a seller's market. But that's kind of it. Let me know your thoughts in the comments. Follow me for more.